Hi everyone, welcome to today's video. In last video, we saw how one can set their financial goal using UORW framework. In today's video, we are going to see how one can save to meet the financial goals related to emergencies. The emergencies could be related to unemployment or unforeseen medical expenses or untimely death of sole breadwinner of the family. Let's start with emergency fund or unemployment. Imagine a situation in which one loses his job. He needs money to run his day-to-day life almost immediately. Given the situation, one should choose an instrument that guarantees liquidity and capital protection. Let's see which all instruments are meeting these two criteria. Number one, recurring deposit. Recurring deposits are deposits offered by commercial banks in which one can contribute periodically for a given time period. The interest rates could vary anywhere between 3 to 5% depending upon the duration. The best part about recurring deposit is it can be prematurely withdrawn as and when needed, and the capital is protected from loss. Number two, liquid mutual funds. Liquid funds invest the money on bonds that mature anywhere between 3 to 6 months. That means the money is available at any time, it's highly liquid, and the capital is almost protected from loss. Even though there is still a residual risk of losing a capital, but it is not that high. However, one should check the credit rating of bonds in which the mutual fund invests before making any investment decision. Let's look at the second uncertainty, that is unforeseen medical expenses. The instrument available to mitigate this risk is sufficient health insurance policy. In last video, we saw that a family of three would require at least 5 to 10 lakh worth coverage. Let's look at some of the criteria one should keep in mind before finalizing a health insurance policy. The first one is copay or copayment. The copayment for most insurance companies vary anywhere between 10 to 20%. In my opinion, you should not choose an insurance policy that has copayment of more than 10%. Bear in mind that the cheaper the premium, there is high possibility of high copayment. So keep an eye on co-payment clauses before finalizing any health insurance policies. Number two, waiting period for pre-existing illnesses. Most insurance companies have a waiting period of 3 years for some of the pre-existing illnesses. So one should choose a policy that has got shorter waiting period for pre-existing illnesses. Number three, disease exclusion. Health insurance companies exclude some of the diseases that would require expensive treatment. So one must keep this in mind before buying or finalizing a health insurance policy. Number four, the number of hospitals in the network of health insurance company. If you have more number of hospital in the network, then the treatment becomes hassle-free. You can easily avail cashless treatment. Lastly, you should check the reputation of the company. It is critical because if the company goes bankrupt, then you could potentially lose your health insurance coverage. How to buy health insurance? You can buy health insurance either by visiting the website of the particular health insurance company or by visiting online insurance distributors like Policy Bazaar, CoverFox, or Ditto Insurance. You can key in your personal details and it will list down the suitable health insurance policy for you and your family. Now let's look at the third uncertainty one should be prepared for. That is untimely death of the sole breadwinner of the family. One can mitigate this risk by buying sufficient life insurance cover. We saw in the last video that minimum coverage should be at least 10 times the annual salary or 20 times the annual expenses of the family. Now let's look at some of the criteria one should keep in mind before buying a life insurance. What should be the policy period? See, the life insurance is to mitigate the risk arising out of absence of sole breadwinner of the family. In India, a person usually retires anywhere between 58 to 60. Hence, optimally, a person would need insurance cover only till he or she reaches 60. A second criteria is claim approval ratio. As long as the claim approval ratio is over 92%, it is good. But one should also consider the absolute number of claims approved by the insurance company. For example, a company may have claim approval ratio of 99%, but the number of claims they actually received and the number of claims they approved are actually small. On the other hand, a big insurance company may have a claim approval ratio of 96%, but the amount of claim they receive would be enormous. So you should always keep both the claim approval ratio and the absolute number of claims received in mind before finalizing a life insurance policy. The third criteria is reputation of the insurance company. One should choose an insurance company that has been in the business for a very long time to ensure that it doesn't go bankrupt. Finally, one should choose pure term insurance as against an endowment plan that blends insurance with investment. In endowment plans, one neither gets sufficient insurance coverage nor gets sufficient returns out of the investment made. Now let's look at how one can buy term insurance. You can visit the websites of the insurance companies, or you can visit the online insurance distributors like Policy Bazaar, CoverFox, or Ditto Insurance. You can key in your personal information and it will show up the list of policies suitable for your needs. With this, we have come to the end of today's video. In next video, we will see how one can save for the financial goals related to kids' education, wedding, or financial goals related to one's wants, like buying a house, car, or making a trip to fancy vacation spots. Hope you found this video useful. If you like it, please share it with your friends. And if you have any questions or queries, please leave them in the comment section. I will get back to you. I'll see you in the next video. Till then, take care. Bye.